If you had $1,000, or $10,000, or even $100,000, where should you invest it? Should you buy individual stocks? Should you put your money in ETFs? Or should you jump into real estate? Everyone seems to have an opinion. Some people swear by stocks. Others say real estate is the only way to get rich. And then there's this new generation of investors pouring money into ETFs for diversification. So, which one is actually best? In this video, we're going to break it all down, step by step. By the end, you'll know exactly how ETFs, stocks, and real estate compare, the pros and cons of each, and which might be the smartest move for your financial goals. Welcome to Smart Dollar Mindset, the channel that helps you achieve financial freedom through smart money habits and investing strategies that actually work. Let's dive in. Why this question matters. Before we even compare these options, let's talk about why this question matters so much. Because here's the truth, where you put your money will decide your financial future. If you invest in the wrong vehicle, or worse, don't invest at all, you could lose years of growth, thousands of dollars, and miss out on the life you want. The good news? All three of these options, ETFs, individual stocks, and real estate, can build wealth. But they work very differently. And depending on your risk tolerance, time horizon, and goals, one will fit you better than the others. So, let's break them down one by one. Part 1, Stocks, the classic wealth builder. When people think of investing, they think of stocks. Buying shares of companies like Apple, Tesla, or Amazon. And for good reason. Stocks have created millionaires, and billionaires, for decades. How stocks work? When you buy a stock, you're buying a piece of a company. If the company grows, the stock price usually goes up. If the company struggles, the price goes down. You can make money with stocks in two ways. Capital appreciation, the stock price goes up. Dividends, some companies pay a portion of profits to shareholders over the long term. The stock market has averaged about 10% annual returns. That's why so many people recommend it for wealth building. But stocks come with big risks, volatility. The market can swing wildly. Remember 2020? Stocks crashed 30% in a matter of weeks. If you panic and sell, you lose. The pros of stocks: high growth potential. Some stocks explode in value. Liquidity, easy to buy and sell quickly. Ownership, you own a piece of a company. The cons of stocks: risk, prices can drop fast. Requires research, picking winners isn't easy. Emotional investing, many people buy high and sell low. Case study, two friends, two strategies. Alex and Chris both start investing with $10,000. Alex picks individual stocks. He buys Tesla at $200 a share and Apple at $130. 5 years later, Tesla skyrockets, and Alex doubles his money. Great, right? But Chris isn't so lucky. He picks 5 hot stocks that crash during a recession. After 5 years, his $10,000 is worth $6,500. This is the reality of individual stocks. You can win big, or lose big. So, is there a safer way to invest in stocks without betting everything on a few companies? Yes, and that's where ETFs come in. Part 2, ETFs, the diversified approach. ETFs, or exchange-traded funds, are like baskets of investments. Instead of buying one stock, you buy a collection of stocks, or bonds, or other assets, in a single fund. Think of an ETF like a grocery basket. Instead of buying one apple, one stock, you buy the whole basket of fruits, hundreds of stocks. How ETFs work? Most ETFs track an index like the S&P 500, which includes 500 of the largest US companies. So when you buy an S&P 500 ETF, you own a piece of every company in that index, from Apple to Microsoft to Coca-Cola. The benefit? Instant diversification. If one company crashes, it barely affects your portfolio. ETFs also have lower fees than mutual funds and trade like stocks. The pros of ETFs: diversification, reduces risk. Low cost, many ETFs have expense ratios under 0.1%. Easy to buy and sell, just like a stock. The cons of ETFs: less explosive growth. You won't get Tesla-like gains overnight. Still subject to market swings. If the market crashes, so does your ETF. Passive strategy: you don't control what's inside the fund. Case study: Alex versus Sarah. Remember Alex from earlier? He doubled his money picking Tesla. But he could have lost it all if Tesla tanked. Sarah, on the other hand, put her $10,000 in an S&P 500 ETF. After 5 years, she averaged 10% returns per year. Her money grew to about $16,000. Not as flashy as Alex, but far less stressful, and far less risky. ETFs are perfect for long-term investors who want steady, consistent growth without gambling on individual stocks. So, if ETFs are so great, why does real estate still have such a strong fan base? Let's talk about that. Part 3, Real Estate, the tangible asset. Real estate is a favorite among millionaires for one reason: leverage. When you buy stocks or ETFs, you use your own money. But with real estate, you can use other people's money, banks, tenants, even investors. How real estate builds wealth: appreciation. Property values tend to rise over time. Cash flow, rent from tenants. Tax benefits, deductions for mortgage interest, depreciation, repairs. Leverage, control a $300,000 property with a $60,000 down payment. The pros of real estate: leverage increases ROI, you can build wealth faster. Cash flow potential, rental income can provide steady cash. Tangible asset, you can see and touch your investment. The cons of real estate: high barrier to entry, you need a big down payment. Illiquidity, hard to sell quickly. Management headaches, tenants, maintenance, repairs. Case study: Lisa's duplex. Lisa buys a $250,000 duplex with 20% down, $50,000. She rents out both units for $1,200 each, bringing in $2,400 per month. Her mortgage and expenses total $1,600, leaving $800 in positive cash flow every month. Plus, as the property appreciates and the mortgage gets paid down, her equity grows. In 10 years, that one duplex could add 6 figures to her net worth. That's the power of real estate: cash flow plus appreciation plus leverage. The key differences between these three. Now that we've broken them down, let's compare them side by side. Feature stocks: ETFs. Real estate. Risk: high, moderate, moderate. Diversification: low, high, depends on properties. Liquidity: high, high, low. Capital needed: low, low, high. Cash flow: no, no, yes. Management: none, none, high. Which one should you invest in? Here's the truth. There is no single best investment. It depends on your risk tolerance, your time horizon, your goals, your available capital. If you want simplicity and diversification, ETFs are a fantastic choice. If you want high growth and are willing to do research, individual stocks can be rewarding, but risky. If you want cash flow and leverage, real estate is your game. Personally, I believe in a mix. Diversification isn't just about stocks, it's about asset classes. A smart portfolio might include ETFs for stability, some stocks for growth, and real estate for cash flow and leverage. How I'd start: with $1,000, $10,000, or $100,000 with $1,000. Start with ETFs. Buy an S&P 500 ETF like VU or SPY. It's diversified, low cost, and beginner friendly. With $10,000, still start with ETFs, but you can add some individual stocks for growth, maybe 80% ETFs, 20% stocks. With $100,000, diversify across all three. $50,000 in ETFs and stocks, $40,000 toward a real estate down payment, $10,000 in cash reserves. The power of combining all three. Imagine this portfolio. ETFs for steady growth and low effort, a few stocks for upside potential, one rental property for cash flow and leverage. The combination gives you diversification, income, appreciation, and scalability. That's how you build wealth in 2025 and beyond, not by betting everything on one thing, but by creating a balanced portfolio that works together. Final thoughts. So, which should you invest in, ETFs, stocks, or real estate? The answer isn't one or the other. The answer is, start where you are, with what you have, and build from there. If you're a beginner, start with ETFs. If you're comfortable with risk and want to learn, add stocks. If you have the capital and patience, add real estate. And remember, the best investment you can make is in your financial education, because the more you know, the better decisions you'll make. If this video helped you understand the difference between these investment options, hit subscribe to Smart Dollar Mindset. We're here to give you real, practical strategies for building wealth and achieving financial freedom. The goal isn't to pick the trendiest investment. The goal is to build a portfolio that buys back your time, your freedom, and your peace of mind.